Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Valero Energy is the largest independent petroleum refiner in the world. It operates 15 refineries across the United States, Canada, and the United Kingdom with nearly 3 million barrels of daily capacity.
The company was founded in 1980 in San Antonio and grew through bold acquisitions. The 2005 Premcor deal was transformational, essentially doubling refinery capacity and locking in the top-tier scale position.
Refining is a spread business. Valero buys crude oil and sells refined products. The margin, called the crack spread, is the difference between those two prices, and it drives almost all profitability.
What makes Valero's refineries special is their complexity. They are engineered to process heavy sour crude grades, which are cheaper than light sweet crude. That discount creates structural cost advantage versus simpler refiners.
Revenue is overwhelmingly in refining, around 94% of the total. The remaining 6% comes from the renewable diesel and ethanol segments, which are growing in strategic importance.
The renewable diesel operation, Diamond Green Diesel, is a joint venture with Darling Ingredients. It is the largest renewable diesel producer in the United States and captures regulatory credits that add to its economics.
Refinery utilization runs consistently around 92% across the network. Throughput capacity sits near 3 million barrels per day. Both metrics reflect strong operational discipline that separates Valero from lower-tier peers.
On the competitive landscape, Valero's primary peers are Phillips 66, Marathon Petroleum, and PBF Energy. Valero differentiates through its Gulf Coast concentration, complex configuration, and renewable diesel scale.
The Gulf Coast footprint is strategically important. The region connects directly to Permian Basin, crude supply, major pipeline infrastructure, and export terminals, reducing logistics overhead on both input and output.
CEO Lane Rigdon took over in 2023, succeeding long-tenured predecessor Joe Gorder. Rigdon spent 2 decades advancing through Valero's refining operations, giving him deep technical and operational credibility across the entire refinery network.
Valero has raised its dividend for 14 consecutive years. The total annual payout runs approximately $1.7 billion, representing one of the more consistent capital return programs among major refiners.
The energy transition adds meaningful strategic nuance. Valero is not ignoring it. Diamond Green Diesel represents a deliberate hedge into lower carbon fuels, while the core refining franchise continues to generate the majority of cash flow.
The long-term picture for refining includes durable global demand in aviation fuel, marine bunkers, and petrochemical feedstocks, even as passenger gasoline faces gradual pressure from vehicle electrification trends.
Valero's balance sheet strength allows it to be opportunistic through the commodity cycle. During refinery downturns, it has historically acquired assets at distressed prices, reinforcing scale advantages across its footprint.
That's the company chapter for Valero Energy. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Valero just printed a Q1 2026 that crushed the EPS line, $4.22 against the Street's $3.16, a 33% beat. Revenue $32.4 billion, up 7% year over year. Refining swung from a $530 million loss to $1.8 billion in operating income, but the stock fell 3.7% on softer Q2 throughput guidance. This is Charged Alpha. Let's break it down.
Valero Energy is the world's largest independent petroleum refiner. The company runs 15 refineries across the United States, Canada, and the United Kingdom, with total throughput capacity of roughly 3.2 million barrels per day. They convert crude oil into gasoline, diesel, jet fuel, and petrochemical feedstocks for distribution across North America and export markets.
Beyond traditional refining, Valero owns 12 ethanol plants in the U.S. Corn Belt and is the controlling partner in Diamond Green Diesel, a joint venture with Darling Ingredients that's now the largest renewable diesel producer in North America. Renewable diesel and ethanol give Valero a foothold in the energy transition, while the core refining business generates the cash. The market cap sits around $70 billion, with a beta of 0.61, well below market average.
Let's walk the Q1 numbers. Revenue $32.38 billion, up 7% from last year and beating consensus of $30.7 billion by over $1.5 billion. Net income attributable to stockholders was $1.26 billion or $4.22 per share, compared to a $595 million net loss in Q1 last year. That's a swing of nearly $2 billion in profitability year over year, driven almost entirely by stronger refining margins.
The refining segment is the headline. Operating income $1.83 billion versus an operating loss of $530 million in Q1 2025. Total refining margin expanded from $2.49 billion to $3.91 billion. Throughput averaged 2.9 million barrels per day. Cash operating expenses ran $5.13 per barrel. Tight cost control on top of expanded crack spreads.
The renewable diesel segment delivered $139 million in operating income versus a $141 million loss a year ago. Sales volumes averaged 3 million gallons per day. Ethanol contributed another $90 million in operating income, up from $20 million. Both transition fuel segments returned to meaningful profitability after a difficult 2025.
On the balance sheet, cash of $4.69 billion, total debt of $10.62 billion, net debt around $5.93 billion, stockholders' equity of $23.7 billion, trailing 12-month free cash flow of approximately $5.4 billion. That FCF base is what funds the dividend and the buyback simultaneously.
Capital return remains aggressive. Valero pays a $1.13 quarterly dividend, about $4.52 annualized, yielding roughly 1.95% at the current price. The company has historically returned over 40% of operating cash flow to shareholders through repurchases. Share count has trended down meaningfully over the past 5 years.
One context note: refiners run on thin gross margins by design. Valero's gross margin sits around 5.4%. That's normal for this industry. The economic engine is volume and crack spread, not percentage margin. When you're processing 2.9 million barrels a day and the crack spread widens by even a few dollars, the absolute dollars of profit explode. That's exactly what happened in Q1.
Analyst sentiment is constructive. The consensus shows 10 buy ratings, 3 holds, and 0 sells. That's a rare 0-sell stack for a cyclical refiner. Average price target sits around $211, with the high end near $290 and the low end near $170. The stock at $242 trades above the average target, meaning the print and the rally have moved ahead of formal analyst updates.
Valuation looks reasonable for a refiner. Forward PE around 14.4 times. EV to EBITDA approximately 7.8 times. Price to sales of 0.57. That low PS multiple is structural for refiners because revenue is enormous relative to market cap. Don't read PS as cheap or expensive on its own. For refiners, EV to EBITDA and free cash flow yield matter far more.
The bull thesis from the street centers on the cycle. Refining capacity globally has been shrinking. Multiple closures in Europe, Australia, and California. That structural supply discipline supports stronger crack spreads through the cycle. Bulls argue Valero is positioned to benefit disproportionately because their Gulf Coast and Mid-Continent assets are among the most cost-competitive in the world.
The cautious analysts focus on Q2 throughput guidance. Valero guided Q2 throughput meaningfully below Q1 levels. Gulf Coast 1.69 to 1.74 million barrels per day, plus reductions across the other regions. Part of that is the Benicia refinery idling and reduced rates at Port Arthur. The market read that as near-term margin compression and sold the stock 3.7%.
Forward EPS consensus for full year 2026 sits around $16.80. At the current price, that's a forward multiple in the mid-14s. Forward revenue is roughly $117 billion. The earnings power is there if crack spreads cooperate. But crack spreads are notoriously cyclical, which is why refiners trade at lower multiples than most sectors.
Bull case rests on 3 pillars. First, the crack spread cycle is in Valero's favor. Global refining capacity rationalization continues. Fewer barrels of refined product capacity chasing steady demand means margin tailwinds for surviving operators. Valero is one of the lowest cost survivors.
Second, the renewable diesel optionality. Diamond Green Diesel is now profitable at $139 million in segment income for the quarter. As sustainable aviation fuel demand ramps over the next several years, that infrastructure becomes increasingly valuable. Ethanol is also delivering. $90 million versus $20 million year over year shows the Corn Belt assets are pulling weight.
Third, capital return. With trailing free cash flow over $5 billion, a sub 2% dividend yield, and aggressive buybacks, Valero is a cash return machine when the cycle works. The Benicia idling is actually a capital discipline signal. They're shrinking the lower return parts of the portfolio to fund returns and concentrate capacity at high-margin assets.
Bear case starts with crack spread compression. Refining margins are notoriously mean reverting. The Q1 strength was driven by a confluence of tight inventories, refinery downtime elsewhere, and seasonal demand. If any of those reverse, and historically they always do, the $1.8 billion in refining segment operating income compresses fast. Valero is highly operationally levered.
Crude oil price volatility is the second risk. As the buyer of crude, Valero benefits when crude declines faster than refined product prices and gets squeezed when crude rallies into a soft demand environment. OPEC plus supply decisions, geopolitical shocks, and unexpected inventory swings can flip the margin equation in either direction within weeks.
Third risk, the Q2 throughput guidance. Lower throughput from Benicia idling and Port Arthur rate reductions means less product to sell into whatever crack spread environment Q2 delivers. Even if margins stay healthy, the volume drag is real. The market priced that in immediately with a 3.7% post-earnings drop.
Fourth, the long-term EV adoption story. Gasoline demand in mature markets is plateauing, and electric vehicle penetration eats into the addressable market over a decade-plus horizon. Throw in tariff disruption to Canadian and Latin American crude flows. Valero's Gulf Coast complexes process heavy sour crude and depend on those imports, and there are real structural headwinds beyond the cycle.
Valero's peer group is Phillips 66, Marathon Petroleum, and PBF Energy. All four are independent U.S. refiners with overlapping geography but different asset mixes. Versus Phillips 66, Valero is more pure-play refining. PSX has a larger midstream and chemicals component that smooths earnings. Phillips trades at a slight premium for that diversification.
Versus Marathon Petroleum, Valero has higher refining margin capture per barrel historically. Valero's Gulf Coast complexes are configured for heavier, cheaper feedstock with strong distillate yield. Marathon has the MPLX midstream MLP advantage, which provides stable cash distributions that Valero doesn't have. Different trade-offs depending on whether you want pure cycle exposure or hybrid stability.
PBF Energy is the higher beta refiner play. Smaller, more leveraged, swings harder in both directions. Valero is the safer, more diversified version of the same trade. If you want refining exposure with lower balance sheet risk and a real renewable diesel platform, Valero is typically the institutional choice.
On valuation, all four refiners cluster in the 7 to 9 times EV to EBITDA range. Valero around 7.8 times sits in the middle. The differentiator across cycles is who has the lowest cost per barrel and the most flexible feedstock slate. Valero scores well on both metrics, which is part of why the analyst stack shows 0 sells, rare for any cyclical name.
Options activity around the Q1 print was textbook. Implied volatility was elevated heading into earnings, and the options market priced roughly a 4% move. The actual move, down 3.7% on the throughput guidance, landed inside that implied range. Anyone who sold premium into the print captured the volatility crush.
Post-earnings positioning shows downside hedging at the 230 and 235 strikes. That's tactical protection from holders worried about the Q2 throughput guidance translating into an earnings reset. Upside call activity sits at the 260 and 270 strikes for those expecting crack spread strength to persist into the summer driving season.
On insider activity, there's been no material insider buying or selling clusters around the print. Valero executives operate under pre-scheduled 10b5-1 plans for any equity sales. The absence of insider buying isn't a bearish signal. It's typical for an established large cap where management already holds substantial equity through long vesting awards.
Institutional ownership runs about 80% of float, with Vanguard and BlackRock as the largest passive holders. Active institutional managers are split. Some treat Valero as a core energy holding, others rotate in and out based on the crack spread cycle. The high passive ownership, combined with a 1.95% dividend yield, gives the stock a stable shareholder base, even when the cycle wobbles.
Bottom line on Valero, blowout Q1, refining swung to $1.8 billion in operating income, renewable diesel and ethanol, both profitable. The print was excellent, but Q2 throughput guidance flagged near-term softness.
If you own it for the cycle and capital return, the thesis is intact. New buyers should respect that the stock trades above the analyst average target. Charged Alpha rates this a constructive cyclical hold. Wait for crack spread weakness to add.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.